Hi there. If your business turnover has fallen, you may be able to deregister for VAT. Here's what UK businesses should understand.
Imagine for a second literally throwing away a 20% pricing advantage over your competitors for absolutely no legal reason. Picture this, you're a UK small business owner. You've worked incredibly hard to build your company, but recently, maybe you lost a major contract, or perhaps you've intentionally scaled back your operations just to find a bit of a better work-life balance. Because of this, your sales have dropped significantly below the required thresholds. But out of sheer habit, or maybe just a lingering fear of HMRC, you're still unnecessarily charging your clients an extra 20% VAT. By doing this, you might be making your pricing completely uncompetitive in a really tough market, all while dealing with quarterly administrative headaches that you are no longer legally required to do. Well, welcome to this explainer. Today we're going to look at the exact safe exit strategy for deregistering for VAT in the UK.
So I want you to pose yourself this critical question. What exactly happens to your VAT obligations when your 12-month rolling turnover suddenly drops? Now, this is a scenario that touches a lot of different taxpayers. It affects freelancers who are reducing their billable hours, and it definitely impacts property landlords who might be shifting their portfolios from commercial over to residential lettings. But today, our main focus is on you, the UK small business owner. When your sales dip, you might actually have a golden opportunity to exit the VAT system, immediately lower your prices for your customers, and completely cut down on that immense paperwork burden, especially those really strict digital requirements brought in by making tax digital. Exiting sounds absolutely wonderful, doesn't it? But there is a massive catch. Getting this process wrong and falling into what we call the hidden asset trap can actually cost you far more than just staying in the system. And that is exactly why Atlas Tax Advisors, or ATA for short, is here. ATA is your expert UK accounting firm acting basically as your ultimate shield against HMRC penalties and administrative missteps. They specialize in guiding UK taxpayers step by step through complex tax compliance issues exactly like this one. Navigating the rigid and, let's be honest, often unforgiving HMRC rules doesn't have to be a solo journey. ATA is a trusted, find-me partner dedicated to making absolutely sure you don't fall into any hidden traps along the way, keeping your business safe, secure, and fully legally compliant. Here is our roadmap of exactly what we'll cover in today's explainer to help you safely exit the VAT system in the 2026-27 fiscal year. We're going to look at what happens when sales drop below £88,000, compare voluntary and compulsory deregistration, uncover that hidden business asset trap I mentioned, walk through the step-by-step cancellation process, talk about reclaiming VAT after you cancel, and finally, wrap up with your next steps. All right, let's dive right into Section 1, when sales drop below £88,000. The absolute foundation of your exit strategy revolves entirely around one specific number. The deregistration threshold for the 2026/27 tax year is exactly £88,000. Now you might be wondering, hang on, why is this number different from the $90,000 threshold required to register in the first place? Well, HMRC deliberately created this $2,000 buffer to solve a major administrative headache known as bracket creep. You see, without this $2,000 buffer, a micro business with minor turnover fluctuations hovering right around the $89,000 mark would be constantly forced to cycle in and out of the VAT system week after week. It would be a total bureaucratic nightmare for both you, the business owner, and for HMRC. So by setting the exit threshold just slightly lower at $88,000, it provides enormous psychological relief for a micro business owner who is stressing over every single invoice. If your taxable turnover drops below this $88,000 mark, the door to legally exit the system officially opens. Understanding the difference in how HMRC calculates these limits is absolutely paramount. When you initially register for VAT, you're subjected to a backward-looking test. It's like looking in the rearview mirror. You're required to check your rolling 12-month turnover to see if you've breached that £90,000 mark in the past. But deregistration? That is entirely different. It's a forward-looking projection. You're looking out the windshield. To successfully deregister, you must convince HMRC that your taxable turnover will remain below £88,000 for the next 12 consecutive months. And this requires you to demonstrate a reasonable expectation based on commercial reality, not just a temporary dip or a quiet month. For instance, HMRC is definitely not going to accept an excuse like, well, I plan to take more holidays next year. However, they will readily accept hard evidence that a $30,000 annual client contract has been officially terminated. Moving right along to Section 2, voluntary versus compulsory VAT deregistration. So compulsory deregistration is exactly what it sounds like.
You are legally mandated to cancel your VAT registration within 30 days if you completely cease trading, if you entirely stop making taxable supplies, or if you change your legal business structure, like, for instance, moving your operations from a sole trader over to a limited company. Voluntary deregistration, on the other hand, is a strategic choice. This happens when your business is still very much alive and kicking, but your turnover simply dips below that $88,000 mark. Here, you actually get to strategically choose whether leaving the VAT system benefits your pricing and cash flow. In some cases, staying in is actually the smarter move. For example, if your business primarily buys zero-rated goods but sells standard-rated services, staying voluntarily registered might actually allow you to claim regular, really lucrative VAT refunds directly from HMRC.
But what happens if your sales spike is just a one-off anomaly? Did you know there's actually a specific provision designed exactly for this? It's called an exception from registration. If you land a massive one-off contract that temporarily pushes you over the £90,000 registration limit, but you can definitively prove your sales will plummet back below £88,000 over the next 12 months, you can apply for a temporary waiver using Form VAT 5EX. But be warned, HMRC is incredibly strict about this. As the recent 2025 Don Caffel Tribunal case definitively proved, simply telling HMRC you intend to work less is not nearly enough. The tribunal ruled that taxpayers must provide concrete, documented commercial evidence of a non-recurring event to actually qualify for this exception. Okay, let's jump to Section 3, and you'll want to pay close attention to this one, the hidden business asset trap.
Here is a professional tip straight from the experts, and it really functions as a crucial industry secret. Getting deregistration wrong can cost you far more than staying registered. Exiting the VAT system is not an automatically beneficial move for every single business out there. If you regularly recover significant input VAT on your standard purchases, and your main customers are large VAT-registered businesses who honestly don't mind you charging them an extra 20%, maintaining your registration might actually be your absolute best financial move. But if you do ultimately decide to leave, you run headfirst into the asset trap.
Under HMRC's deemed supply rules, when you deregister, you are treated as having made a deemed self-supply of all the business assets you still hold on your official cancellation date. Think about your fleet of transit vans, maybe those really expensive Apple MacBooks you bought for the design team, or specialized manufacturing equipment just sitting on the factory floor. If you previously claimed input VAT from the government when you originally bought those items, HMRC now views this deregistration as if you are selling those assets back to yourself at their current open market value. Consequently, they tax them at the standard 20% rate. HMRC rigorously enforces this rule to claw back the tax advantage you gained while you were operating inside the VAT system.
Within these rules, there is a hidden danger limit that you absolutely must be aware of. And honestly, it is a remarkably low threshold, just £1,000. You are legally required to pay output VAT on your final return if the total VAT due on all your retained business assets exceeds the £1,000 de minimis limit. It is incredibly easy for a small business to accidentally trip this wire, just by holding on to a few decent pieces of equipment or even a single aging commercial vehicle. And remember, this is absolutely crucial. The limit is strictly based on the VAT due, not the overall market value of the assets themselves.
Let's walk through the math clearly here, because the application of this rule is incredibly strict. If you hold £5,000 worth of applicable assets at their current market value, 20% of that equates to exactly £1,000 in VAT. Because that figure does not exceed the limit, you safely avoid the charge entirely. Zero output tax is due. However, if your assets are worth just a fraction more, say £6,000, well, the VAT on that is £1,200. Because it exceeds that $1,000 limit, the entire $1,200 amount becomes instantly due to HMRC on your final return. Not just the $200 difference, the whole shebang. This cliff edge penalty is exactly why a smart business owner will strategically sell off or properly dispose of older business assets right before submitting their cancellation form, safely maneuvering around this frankly devastating charge. Now for Section 4, the step-by-step VAT cancellation process. The mechanics of cancellation are straightforward, but they do require absolute precision. Step 1, verify your eligibility and meticulously gather up your records. Step 2, submit Form VAT 7. For most small businesses, the easiest route is doing this online via your government gateway account, though paper forms are still required if you are officially changing your legal entity. Step 3, patiently wait for HMRC confirmation. And listen, this is where so many businesses fail. You must continue charging and accounting for VAT until HMRC officially confirms your deregistration date in writing.
If you jump the gun, stop charging VAT, and HMRC takes a month to process your form, well, you become personally liable to pay that 20% out of your own profit margin for every single sale made during that limbo period. That can completely wipe out your profits. Finally, step 4, submit your final VAT return.
Let's break down the timeline, starting with a pretty severe urgency warning. If your deregistration is compulsory, you have exactly 30 days to notify HMRC to avoid aggressive compliance fines. Once you successfully submit Form VAT-7, HMRC typically takes 3 to 5 weeks to process the documentation. After official cancellation, you must submit your final return. Now, thanks to a really highly beneficial regulatory change that was formalized in June 2025, you legally have 1 month and 7 days from the date HMRC actually makes the final return available to you online. This critical update is fantastic because it protects taxpayers from unfair late filing penalties caused entirely by HMRC's own internal administrative delays.
Moving on to Section 5, reclaiming VAT after you cancel.
So what happens if you receive late purchase invoices for services provided while you were still legally registered? Or what if you have clients who completely failed to pay you and you need to claim bad debt relief? Well, you are fully entitled to use Form VAT-427. You generally have a fairly generous 4-year limit to claim this specific relief. However, remember this absolutely unbending rule. Even though you are no longer operating within the VAT system, HMRC mandates that you retain all of your historical VAT records. I'm talking every invoice, return, and piece of correspondence for a full 6 years from your cancellation date. A vital piece of advice here is to digitize your physical receipts. Thermal ink on physical receipts often fades to blank paper over 6 years. And trust me, HMRC will absolutely not accept a blank piece of paper during a compliance audit.
And finally, Section 6, summary and your next steps.
Navigating the complexities of VAT deregistration, properly timing your exit, and crucially, avoiding that devastating 1,000-pound asset trap requires absolute precision. But you really don't have to do this alone. I highly encourage you to contact Atlas Tax Advisors to flawlessly manage your VAT-7 submission and your final returns so you can exit safely. You can reach their expert team directly by phone at 07404-427-275 or shoot them an email at info@atlastax.co.uk. You can also visit their website at www.atlastax.co.uk. Now, a quick disclaimer before we sign off. This explainer is strictly for educational purposes and does not constitute formal tax advice. UK tax rules and HMRC thresholds are always subject to change, so please be sure to consult a qualified tax professional regarding your specific personal or business circumstances. So, the final provocative question for you is, are you ready to smoothly transition out of VAT and keep significantly more revenue inside your own business? If you found this explainer valuable and you want to stay ahead of HMRC rules, make sure to subscribe to the ATA YouTube channel today for more incredibly empowering expert insights. Thank you so much for joining us for this explainer, and we will catch you next time.